Are you currently holding an asset that in 2026 could drop 30%, 40%, even 60% in value? Sounds scary, right? But let me ask you this: if a massive wave is coming, do you want to be the one swept away, or the one standing safely on shore, waiting to collect gold after the water recedes? The truth is, financial history has never really changed. Every 7 to 10 years, the market goes through a cleansing cycle. And I believe 2026 could be a once-in-a-decade opportunity. Not because everything will skyrocket, but because many things will collapse. Sounds paradoxical? But do you know who gets rich the fastest? Not the ones who buy when everything is hot. Not the ones who FOMO in. It's the ones who make money when everyone else is panicking. Think back to 2020.
The world shut down. The Dow Jones plunged. People were dumping stocks.
People held cash out of fear. But what did big investors like Warren Buffett do?
They waited. They prepared capital.
They bought when others were shaking.
And then?
The market recovered strongly. History repeats itself. But the crowd never learns. I'm not saying this to scare you. I'm saying this because I see so many people holding assets they believe are safe, untouchable, guaranteed to win. But if you understand global capital flows, you'll realize that what we're seeing in 2024 to 2025 may just be the setup for a major reversal. Right now, the most important question isn't, what should I buy to get rich? It's, what is likely to collapse so I don't get trapped?
Imagine this.
Someone sold their house in 2011 thinking real estate was finished. Prices tripled afterward. He regretted it for life. Someone converted everything into USD fearing their local currency would lose value. But when the cycle turned and the dollar weakened, they missed opportunities elsewhere. Someone held cash because investing felt risky. Meanwhile, inflation quietly eroded 5 to 7% of purchasing power every year.
Do you see the pattern?
Sometimes what we think is safe is actually the biggest risk. And this is an extremely sensitive moment. The world is at the intersection of prolonged high interest rates, record global debt levels,
geopolitical tensions,
AI reshaping the job market, capital rotating away from old assets. If you only look at the surface, everything seems fine. But if you understand global money flow, you'll see the foundations are shaking. And I'll say it again, this could be a once-in-a-decade opportunity. Because when assets collapse, opportunities are born. When bubbles burst, smart money reallocates. When the crowd panics, those who understand the game can change their lives. That's why I made this video. Not to be pessimistic, but to help you prepare. Prepare your mindset. Prepare your strategy. Prepare your position. 2026 won't be an ordinary year. It could be the year when some can't fail assets plunge. Some stable industries get disrupted. Some former investment heavens turn into traps. And the most dangerous part? Most people won't realize it until it's too late. You don't need to be smarter than everyone else. You just need to be one step ahead. Understand global money flow. Understand cycles. Understand that no asset goes up forever. In this video, we'll break down 5 types of assets that could collapse in 2026, based on interest rate cycles, debt structures, monetary policy, and technological disruption. Not rumors. Not clickbait. But strategic thinking. And once you understand these 5, you won't see your portfolio the same way again. You'll start asking, who is accumulating? Who is distributing? Where is capital flowing? Where is the real opportunity? This isn't just a warning. It's a roadmap. A roadmap so you don't get swept away with the crowd. A roadmap so you don't get trapped in assets that look good on the outside but are hollow inside. A roadmap to potentially turn 2026 into the turning point that changes your life. Why do I say 2026 could be a once-in-a-decade opportunity? Because every financial market operates in cycles. Nothing goes up forever. And nothing goes down forever. Markets move in patterns. Expansion euphoria, bubble collapse, restructuring, new cycle. The problem is, most people only recognize the expansion and euphoria phases. When the bubble bursts, that's when they suddenly start learning about cycles. Let's go back to 2008. The global financial crisis began in the U.S. housing market.
Easy loans.
Subprime lending. Inflated asset prices. Everyone believed housing prices would never fall.
What happened?
A chain reaction collapse.
Banks failed.
Stock markets crashed.
Millions lost wealth.
But at that same time, those who understood global capital flows saw something different. They saw the Federal Reserve injecting liquidity. They saw interest rates cut near zero. They understood that cheap money would eventually create a new growth cycle.
And it did.
From 2009 to 2020 U.S.
markets surged.
The Dow Jones kept making new highs. Then came 2020.
Pandemic. Panic.
Markets crashed again. But central banks printed trillions of dollars at unprecedented speed. Money never disappears.
It must flow somewhere. It flowed into stocks.
It flowed into crypto. It flowed into real estate. It created bubbles across multiple sectors. This is where you need what I call the third eye. The third eye is the ability to see beyond price charts. It's the ability to track where capital is moving. It's understanding that when too much money is printed, currency loses value.
Look at Argentina. Look at Zimbabwe.
People held piles of cash that couldn't buy basic goods. That's the difference between currency and real money. Currency can be printed. Real money preserves purchasing power. Gold has historically done that. Strategic land has done that. Cash flow generating businesses have done that. But when the cheap money cycle ends, everything changes. Right now, we are in one of the highest interest rate environments in years. Global debt is at record levels. Governments face rising interest burdens. Businesses face higher borrowing costs. Consumers slow spending. The cheap money era is being reversed. And when liquidity tightens, the assets that benefited most from easy money face the greatest pressure.
That's not an opinion.
That's how cycles work. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." Li Ka-shing has repeatedly sold major assets near cycle peaks before downturns. They don't predict emotionally. They observe capital flows. So where are we in the cycle now? High interest rates. Shrinking liquidity. Rising hidden credit risks. Markets that have rallied for years. This is not early cycle energy. This feels like late cycle pressure building. And when the wheel turns, many assets won't react fast enough. This is not pessimism. This is preparation. If you understand global money flow, you won't panic when markets fall. You'll understand that collapse is part of renewal.
And more importantly,
collapse creates once-in-a-decade opportunities. Now let's get specific. These are 5 asset categories that could face serious downside risk in 2026 if liquidity continues tightening and capital rotates.
1.
Highly leveraged speculative real estate. Not all real estate will collapse. But properties bought with heavy leverage, negative cash flow, and short-term flipping expectations are vulnerable. The mechanism is simple. Higher rates, higher borrowing costs, lower demand, falling liquidity, forced selling. We saw this in 2008 in the U.S. housing crisis. If unemployment ticks up or recession hits in 2026, over-leveraged property investors will be the first exposed. Especially land without income generation. When the tide goes out, over-leveraged players are revealed first.
2.
Overvalued growth stocks. During 2020 to 2021, cheap money pushed growth stocks to extreme valuations. P/E ratios of 40 to 60 became normal. But when interest rates rise, future earnings are discounted more aggressively. Investors shift from storytelling to profitability. We saw this after the dot-com bubble in 2000. Many tech stocks lost 70 to 90%. If liquidity tightens further in 2026, high valuation, low profit growth stocks may correct sharply. Cheap money inflates bubbles. Expensive money bursts them.
3.
Long-term cash holdings in an inflationary environment. Cash doesn't crash in price, but its purchasing power can collapse silently. At 5% inflation annually, you lose roughly 25% of purchasing power in 5 years. Short-term safety can become long-term risk. History shows when governments carry high debt, they tend to inflate it away. Excess printing leads to currency erosion. Holding too much idle cash without allocation strategy is a silent collapse.
4.
Traditional businesses that fail to adapt to AI. AI is restructuring cost efficiency and productivity. Companies that fail to adopt automation and technology may see shrinking margins. Higher costs plus higher borrowing rates equals valuation pressure. Just like internet disruption reshaped retail. 2026 may be when markets aggressively reprice businesses that fail to modernize.
5.
Low-quality crypto and speculative tokens. Crypto itself isn't the problem. But tokens with no real ecosystem, no revenue, no adoption, just hype, are extremely vulnerable in liquidity downturns. In 2022, many tokens fell 80 to 95%. If 2026 brings another tightening phase, weak projects may disappear entirely.
Financial Darwinism.
Only assets with real value survive cycles.
The common thread? Cheap money dependency. High leverage.
Excessive expectations. Weak intrinsic value. When global capital rotates, fragile assets fall first.
But remember,
Collapse reallocates wealth. If you understand global capital flow, you won't just avoid risk. You'll prepare for the once-in-a-decade opportunity. If money leaves weak assets, where does it go? Money doesn't disappear.
It relocates.
We are likely approaching a pivot phase in global monetary policy. If central banks eventually shift direction, capital will move fast.
Out of fragile assets.
Into real value. Here's where opportunity may lie.
1.
Gold and defensive assets. When trust in currency weakens, gold regains strength. It's not about yield, it's about preserving purchasing power. Gold acts as financial insurance.
2.
Cash flow strong businesses with low debt. In tightening cycles, quality matters more than growth speed. Companies with strong balance sheets and sustainable earnings become attractive.
Durability beats hype. 3.
Real AI infrastructure and applied tech. After hype cycles clear, true innovators remain. AI-driven productivity businesses may anchor the next cycle. Bubble collapses clear the stage for real leaders. That's where once-in-a-decade opportunities form.
4.
Strategic commodities and resources. Energy, rare metals, food supply chains, these become critical in geopolitical shifts. Tangible assets regain importance in structural inflation.
5.
Strategy, flexibility and diversification.
Don't go all in.
Don't over-leverage. Don't hold idle cash too long. Survival strategy.
Maintain defensive allocation. Own quality growth. Limit debt. Have exit plans.
You don't need to catch the exact bottom. You just need to avoid dying at the top. 2026 doesn't have to be scary. It could be your repositioning year. But only if you understand global capital flow.
Let's recap.
5 assets at risk in 2026. Leveraged speculative real estate. Overvalued growth stocks. Idle long-term cash. Legacy businesses ignoring AI. Low-quality speculative crypto.
The common pattern?
Dependency on cheap money and crowd psychology. When global capital rotates, fragile assets fall first. But collapse isn't destruction. It's redistribution. Wealth transfers from the unprepared to the prepared. That's why the core message is simple. Understand global capital flow.
Don't panic. Prepare early.
You don't need to be smarter than everyone.
You need discipline.
Markets don't reward emotion.
They reward understanding.
2026 could be devastating for some. But for those who prepare, it could change your life. If this perspective helped you see the market differently,
like the video.
Subscribe for deeper cycle analysis.
Comment below.
Backhand index pointing right. Which sector do you believe will boom the most in 2026? Share this with someone who invests. Because this may truly be a once-in-a-decade opportunity. See you in the next video.